Hello everyone, my name is Moji. You're watching a Bitcoin Bubble News channel. July's increased miner revenue compared to June suggests that we may have reached the bottom of this shakeout, following the halving of miner shakeout in June. The difficulty is another reason why the hash rate increased by 10% today. Since a result, we may expect hash rates to rise, which is great news for Bitcoin's security and price stability going forward, since it suggests that small and old miners have really exited the market. A new chart centering on miner revenue has been released by an anonymous Bitcoin analyst who created the Bitcoin stock-to-flow model PlanB. Detailed examination of the income generated by miners across time, keeping tabs on these revenues across several Bitcoin nodes after a cycle, and then looking at how changes in relatively small revenue might affect Bitcoin values. On July 29th, the chart and the former quant analyst and institutional investors' forecast for the top cryptocurrency based on changes in small revenue were revealed in a tweet. Miner revenue bottomed after April 2024 halve, reads the tweet, which has since amassed over 10,000 likes on X. In the next 3 to 5 months, I anticipate that the price of Bitcoin will have doubled from where it is now. PlanB elaborates in subsequent tweets that he expects Bitcoin will trade at about $140,000 per coin by the end of the year, which is in line with his stock-to-flow projection of $150,000 per Bitcoin by the end of 2024. Furthermore, PlanB predicts that Bitcoin's price will reach even greater heights in 2025, and he states that $140,000 will be the cycle's apex. The author expresses his disagreement with a $140,000 cap and dwindling rewards in a tweet. If the stock-to-flow model is correct, then the average price of Bitcoin between 2024 and 2028 will be around $500,000. At the moment, it's quite intriguing and it's Bitcoin tiny revenue. The blocks on the x-axis are what we can see. Halving occurs every 210,000 blocks. A block is thus added every 10 minutes. 4 years equals 210,000 10-minute intervals. Therefore, there is a 50% reduction every 4 years. In April, we recently had one. In addition, when Bitcoin's supply is cut in half, the earnings of miners who create new Bitcoins through mining also decreases by half. By the way, these are all brand new Bitcoins, not the fees, which only make up a tiny fraction of their total income. Then, it's the newly minted Bitcoins. Unfortunately, their income plummets overnight following a halving because they only receive half of the new Bitcoins. This is a terrible situation for any company. They need to get back on their feet after that. Most of the time, small-scale miners quit because they can't make a profit with their outdated, inefficient equipment, which consumes a lot of power and is expensive to run. That was all. What? They must stop as they are losing money. Those miners who are new to the game and have invested in state-of-the-art technology will be the ones to stay if they can maintain a profitable output while also taking advantage of the lowest pricing or even free energy on the market. Every 4 years, Bitcoin undergoes a significant structural event known as a halving, which causes a shakeout. That market shakeup must be able to sustain Bitcoin and the entire Bitcoin market, and that is exactly what we are doing at the moment. As usual, it's quite unpredictable. The hash rate decreases. It has been widely speculated that miners will simply resign, but this has never really occurred. It's all wrong. What matters most, though, is the rapid expansion of this sector. In the beginning, all the miners in the globe were only making roughly $1 million a month. The current monthly revenue for Bitcoin miners is around $1 billion, and it reached a peak of $2 billion. Slicing it in half, we get little under $1 billion. Plus, the current situation is really intriguing. The miner's income can only return to its previous level if the price of Bitcoin doubles, and this has always been the case. With it, half as many Bitcoins might be added to a block. So in order to maintain the current level of mining revenue, the price needs to double. Things are happening in the marketplace at a breakneck pace. I don't think you've missed it, but the stock market has been experiencing a considerable downturn over the past week. Debenture yields are declining, quite drastically. Prices of commodities are declining and, in some instances, completely collapsing. There is a widening gap in the yield spread, which is the difference in interest rates between high-yield bonds and treasury bills, ER bonds. Consequently, there are a lot of signs that worry is making its way into the markets. Also, I'd like to present our viewpoint because we do have one. I'm going to say something slowly, then all at once, but if you've been listening, you've heard it here before. The rolling recession has been a topic of discussion ever since the Federal Reserve began hiking interest rates in 2022. Almost immediately after the Federal Reserve began raising interest rates, the housing market entered a slump. There was already a downturn in the commercial real estate industry. It seems like multifamily properties are becoming a problem. Cars have stalled before. Their growth rates have stopped out at subnormal levels, but they have stabilized somewhat. Capital spending has decreased. Consumer confidence has recently taken a nosedive. The housing market, which had begun to show signs of improvement, has now retreated, at least according to sales data. So far, the recession has been rolling, and now it appears to be hitting all at once. It seems like a lot of folks are starting to see that maybe inflation isn't the main issue after all. Finally, prices will begin to fall as this recession winds down. After hearing Amazon's report last night, I've been stating that deflation and falling prices pose a problem. Customers have made their desires known and are receiving what they want: reduced costs. The buyer has not completely broken down just yet. Even in the car industry, it's a reaction to lowering costs overall, which is bad news for businesses. It indicates that their margins will be squeezed. Therefore, deflationary signals are at the heart of the all at once. Two reports that came out this week were the jobs report and the Purchasing Managers Index PMI. There will be a recession in both of those. As a result, the consensus that a recession is underway is growing. By the way, the sum rule in the unemployment report was triggered when the rate of unemployment rose by 50 basis points compared to its low, as calculated on a 3-month moving average basis. And thus, many more are now considering a recession. Saying something like 0.8 or 0.9 all at once now requires zero thought on our part. Actually, this scenario's rolling recession would cast doubt on that. We are not implying anything in the slightest, but we are making the suggestion. Think there will be a major impact from the current emphasis on pricing power.